Okay, so we are now looking at the two topics. These topics are found in both the investment analysis as well as corporate finance, the CF. So the first topic we are going to look at right now is to do with the risk and return. So we have the risk and return. Okay, so this is about one of the topics that we need to know as we look at investment analysis or be it the corporate finance. So now risk is just the probability that the actual return differs from expected return. Risk is the probability. So risk is a probability that the actual return from an investment differs from expected return. So risk is the probability. Okay, so probability that actual return from an investment differs from expected return. Okay, so risk is a probability that actual return from investment, so from investment differs from expected return. So differs from expected return. Okay. Now, the expected return of a stock, expected return of a stock like stock A is equal to summation of probability by the return. So this is on the expected return of stock. Okay. I mean, similarly, so probability multiplied by the return of A, and then expected return of B is actually equal to summation of probability. Okay, so probability by the return of B. Then the variance of the stock, variance, okay, of a stock, we are simply saying is equal to the probability, let's say the price of a stock A. So probability, then we have return of A minus expected return of A. Then we have return of A minus expected return of A square. Then the last one is on probability, return of A minus expected return of A square. So this is the presentation of the variance of a stock. So our variance is actually the summation of all these ones. So this is the variance. Then the square root of the variance is the standard deviation. So standard deviation is actually equal to the square root of variance. So this is just about what is going on here. Okay, so meaning that if we have to find the variance of stock B, variance of stock B we are simply saying probability return of B minus expected return of B. Then here you have return of B minus expected return of B square. Then probability return of B minus expected return of B square. So as we do these ones, we can find the variance here. Variance is actually equal to that one. So we have this addition, this one. So this is the variance of B. Standard deviation standard deviation is actually equal to the square root of variance. Okay. So this is only getting down to the variance of stock B.
Mr. Stanley,
Yes, please.
I've got a question.
No problem.
Okay, so this probability, that P, which stands for probability,
Yes.
is does it stand alone, or it's a probability of the second column, probability of the third column? Which is which?
Okay, so
The
now,
P.
okay, this P,
Mhm.
let me show you what is going on here. So this P will be given in the question. You can see my breakdown on the whiteboard. So this P that I've written here, this P I've written is multiplying by the difference on this. So, what I'm saying is for you to understand this, where the P is coming from, let me explain now using the assignment first so that you see before I proceed going elsewhere. Okay, so okay, let's see. Let's go to the assignment question. All right, so if I have this question here, an example. Are you able to see the question? Excuse me?
Yes, Mr. Sen.
Okay.
Yes, I can.
Okay, so now let's see. Let me go to a question where this risk and return came in. Like here, question 2. Mwansa Wombwe Limited is contemplating to invest in two assets, that is A and B. The table provides the return distribution of the two assets. So the probability is given there. So probability is P 0.25, 0.50, 0.10, and 0.15, meaning that the total probability should give us 1 when you add all those. Then we have asset A. So we have asset A and asset B. All right, so asset A, we have those returns 40%, 40, 50, 40, 20, negative 10. Then getting down to asset B, we have the 70, the 50, those are returns, the returns of the respective assets. So when answering this question, if you want to find the expected return of A and B, okay, so here from this one, let me use this whiteboard so you can find, we have the P, which is the 0.25. Then of course we have the 0.50, the 0.10, 0.15. Then asset A, so we have asset A, return, we have the 0.5, which is 50%, then 0.4, then we have the 0.2, negative 0.1. Then getting down to asset B, we have the 0.7 return. Then we have also the 0.5. Then we have the 0.1, negative 0.2. First and foremost, if you want to find the expected return of A, is actually equal to summation of probability by the return of A, not so. So meaning it will be the 0.25 multiplied by 0.5. Then of course, plus the 0.5 by 0.4. then we are getting down to plus the 0.1 by 0.2. Then the other one, what would be the other one? If you're following, please. The other one will be what? 0.15 by negative 0.1. So this is our expected return of A, which is giving us what answer? Are people following?
Yes, you are following. I'm trying to calculate.
Okay, calculate.
We are following.
Okay, that's fine. Kindly give me the answer. So confirm it. Should give us a 0.33 or 33%. You can confirm that. All right. So we can get down. I'm sure you can you confirm that? Have you confirmed?
Yes, that's what I got.
Okay, no problem.
0.2.
Okay, so no problem. So so meaning similarly, you need to find expected return of B in the same way. Expected return of B will actually equal to, you aggregate those, so it will be 0.25 by 0.7, then plus the 0.5 by 0.5. Of course, you now say plus the other one is 0.1 by 0.1, then plus the 0.15 by negative 0.2. So let us find the expected return of B. So the answer will be 0.25 by 0.7 plus the 0.5 by 0.5 plus the 0.1 by 0.1 plus 0.15 by negative 0.2. So the answer is giving us the 0.405
0.5,
or 40.5%. 40.5%.
that's what.
So now let's find I'm just going to find for you for the variance of X for A, variance for A. Then for B, you can find your own time, but for as long as you are going to understand what I'm going to do for A. So A is the P. Okay, so P, in this case, how many P's do we have? There are 4 P's, right? There are 4 P's. The first P is what?
0.2.
0.25, correct. So 0.25. So this is, I want you to understand this table that somebody asked about it. this table here. Okay, how you get this table, this someone. So it's this table that we're filling in now, so that you understand how we are getting down to the variance. So here we are going to now say return A minus expected return A. Then this one will be return A, okay, minus expected return A square. Then this other one will be probability return A minus expected return A square. So this is it on the aspect of getting the variance. So return A. The returns for A, we had, so this is 0.5, 0.25, then getting down to 0.5. Then the other one is 0.1, 0.10, 0.15. So return A is 0.5, then minus 0.33. Okay, which will give us the answer here. 0.33 is what we found for A, expected return, 0.33. Then this other one will give us the 0.4, then minus 0.33. It will give us the answer 0.2 minus 0.33. Then the other one is negative 0.1 minus 0.33. So we can get answers there. Are people with me so far?
Yes, I'm following.
Yeah,
We're following,
so
Professor.
this one will give us a 0.17.
Mhm.
Then you square it. You square it to find the second one. So you square that answer is 0.0.
289.
That's what is happening. Now, the last column, you need to just multiply by the probability. This one here, this one, which is this one here, then by the P, which is that one. All right. Are we together?
Yes.
So it will give us what answer there? It will give us the 0.007.
007225.
Correct. 22.
7225.
What are we saying? 0.007225?
Yes,
Which is that one?
7225. That's what I got.
0.0, the same one which is there also.
Yes.
Okay. So let's just move on now to the other one. The 0.4 minus 0.33, 0.07, 0.07. Then you square it. It's giving us the 0.0049. 0.0049. So this is on what you expect as you guys risk and return. Multiply by 0.5. So it's giving us what? It's giving us
0.005.
0.0005. 245. 245. Then the other one will be 0.2 minus 0.33. It's negative 0.13. Negative 0.13. Then you square this answer. It's giving us a 0.0169. Then multiply by 0.1, giving us the 0.00169. The other one is negative 0.1 minus 0.33, negative 0.43, negative 0.43. Then you square this one. It will give us the 0.1849. Then multiply this by 0.15. We are getting the 0.02735. So we can get our variance which will be equal to the additions of those ones as 0.00169 plus the 0.00245 plus the 0.00725. So the answer is giving us the variance of 0.0391. So getting down to the SD, the standard deviation. SD standard deviation is the square root of variance. If they ask you a question about it, so the square root of the variance. So our SD is simply the square root of our variance, which is 0.0391. So our SD will be equal to 0.19. 0.1977. So this is just basically what you need to know as you're finding the variance, because I know somebody wanted to find out the P. I'm sure, have I answered the question for P now? For those who needed to know about the P, I'm sure.
Yes, Mr. Stanley, you have answered. Thank you.
Oh,
it's now making sense.
Oh, okay. Thanks very much. So this
Yes.
is so this is on risk and return. Then, if you want to find the CV for A, CV for A is coefficient of variation is equal to standard deviation of A over expected return of A multiplied by 100%. So this is it on getting coefficient of variation. So this one is coefficient of variation. Okay, so coefficient of variation. So you get to this one here. So this one is standard deviation of expected return. So this one measures higher CV means higher risk. So higher CV means higher risk. Higher risk. Higher risk of a stock. So this is SD is a risk, and this other one is the return. So risk and return aspect. All right, so this is what you expect as you are looking at the risk analysis or risk and return analysis. So it came from here where we are talking about risk. What is risk? So in a nutshell, this is what you expect as you are looking at risk. Okay, of course, we'll be building up a little bit for the full coverage where we get into the portfolio management. Okay, then the basics is this one, expected return of A, B, then getting down to the variance of a stock, where you add this one, that one to get the variance. The standard deviation is the square root of variance. Then for stock B, similarly, you add that one, this one, the variance, standard deviation is square root. Then getting down to this information, we have actually looked at now the expected return of A and B. So A is 83%. B, we found 40.5. The variance of A was 0. After adding that one, this one, and this one, we got this. The standard deviation is square root. Then the higher the CV means higher risk of a stock. All right. Then when we want to find the last part first, before that, we have what we call APM. APM is a capital asset pricing model. Capital asset pricing model. Okay. So under the capital asset pricing model, we simply say the required return, KE, which is required stock return or required return. So required return is actually equal to, excuse me, RF, then plus beta, return of the market minus RF. So B is beta, which measures risk. So that is B. Then RF is risk-free rate. Risk-free rate. And then RM is market return or return of the market. So this one is called market return. Okay. So this is about what goes on as we look at the CAPM. So now the difference between RM minus RF is actually called market risk premium. Market risk premium. So meaning they would have already subtracted whatever it is that they need to subtract. So this is on a CAPM. Okay, finding the required return using the capital asset pricing model. So the example we can look at here is this one, where they simply say the market risk premium is 10%. Okay, so risky premium is equal to 10%. And government treasury bills, which is risk-free, is 8%. And the betas, respective betas for A and B, okay, in different category by market risk or beta of A. So A has a beta of 2, then B has a beta of 3. Okay, so we have those stocks. So meaning, as we are finding the what is needed here, we need to know that as we are using the capital asset pricing model to find the required rate of return, we have to use the formula which should be there. Okay, so one question, that question, these are the answers. Then for A, the required rate of return or risk-free in the question, they are simply saying it is the risk-free rate is the government treasury bills, which is a risk-free because the government can't default. So RF is 8%. Government treasury bills always, even if they don't sell, that is the risk-free rate. Then for A, the beta is 2, the way respective way, the way they are. For A, the beta is 2. For B, the beta is 3. Beta, like I mentioned, measures risk. So beta measures risk. So our risk-free, okay, so risk premium, okay, is what? Is equal to 10%. And then the risk-free rate is what? 8%. So for stock A beta is actually 2. Then stock B beta, stock A, stock B beta is equal to 3. So cost of equity for A is actually equal to risk-free plus beta return of the market minus risk-free. So our cost of equity is actually risk-free, which is the 0.08, then plus beta of 2. The risk premium is 0.1. Okay, the difference between these two is the risk premium. So our cost of equity here, we can sort out that is 0.1 by 2, then plus 0.08, which is 0.28. So is equal to 0.28 or 28%. Then for this one, our cost of equity is actually going to be risk-free is 0.08 plus the beta is 3 on 0.10, which will be KE is equal to 0.38 or 38%. I'm sure you have gotten this one. Are people following that?
We are following, Mr. Sene.
Yeah, so this is how you find, this is when they ask you to use the CAPM, which is the capital asset pricing model. So this is how you go about this one here. All right. So we can now look at the, even from this question for the piece of work for an assignment, this one is just basically what is needed to find the anything else that I want you to calculate using the capital asset pricing model. But now, question 1 was on a different topic altogether, so I have to introduce a topic. So the major thing that you need to cover as you are looking at the risk and return these are the ones here. You need to find expected return of a stock using the capital asset pricing model, finding the covariance of a stock, finding the expected return of a stock and the standard deviation of a stock. Of course, also using the probability values. Okay, and then just about that. Now we can go to the other component because we're getting these questions from part of the assignment, the question that is there. So I want us to go to a different topic altogether. So this is the major ones that you need to know about the risk and return. These ones, of course, will be going deeper for anything else pending concerning the risk and return, but the major ones find the variance and the standard deviation of a stock, the covariance of a stock, of course, the expected return of a stock. All right. So we'll be building up a little bit in getting into the portfolio management. Okay, on the risk and return. So we can now get down to another topic, which is called capital budgeting. So let me just introduce this one so that we can answer some questions. This is capital, the cost of capital, not capital budgeting, but the cost of capital. Okay, so we're looking at the cost of capital, or each one is called capital structure of the business. Capital structure of the business. Now, this one is also called long-term sources of raising funds, or you simply say long-term sources of raising finance. Long-term sources of raising funds. So under this one, there are 3 ways the firm can raise finance. 3 ways a firm can raise finance. Okay, number 1 is the issue of share of common stock. So they can issue shares, issue of shares of common stock. The issue of shares of common stock, that's number 1. All right, then this is called equity. Then also they can issue debentures, which is the unsecured borrowing of the company. This debenture is a debt, and a debenture is unsecured borrowing of the company. So debenture is unsecured borrowing okay of the company. Then what else can the company do? They can issue part-time owners, or they issue shares or you can issue preference shares or preferred stock. The issue of preferred stock. So preferred stock. Okay, now, so from here, we have, after this now, we can calculate the work. So we calculate work. So work is simply weighted average cost of capital. So work is equal to weighted average cost of capital. Okay. So work is a weighted average cost of capital. All right. So now this weighted average cost of capital, the work, looks at the overall capitalization of the company. So looks at overall capitalization of the company. Okay. In terms of debt, equity, and preferred stock. So equity and preferred stock. So this is what the work will look at. Now, there are other things we need to look at first and foremost. Work is equal to cost of equity or multiplied by weight of equity plus the other one is cost of debt. Okay, then 1 minus tax, then multiplied by weight of debt. This is weight of debt. Okay, so this is the one thing on the debt. So I'll give you a breakdown. Then plus cost of preferred stock multiplied by the weight of preferred stock. So this, in summary, we can simply say our work, okay, is equal to weight of equity, cost of equity, plus weight of debt multiplied by cost of debt, 1 minus tax, plus weight of preferred stock multiplied by the cost of preferred stock. This is only the work. So now WE is weight of equity, weight of equity. So the weights, somebody will ask, where do the weights come? We'll actually show you. KE is the cost of equity, cost of equity, Then this one is weight of debt. Weight of debt. Our T is taxation. Then this one is before tax cost of debt. Before tax cost of debt. Then getting down to the other one is WPS is weight of preferred stock. Then KPS is equal to cost of preferred stock. Cost of preferred stock. Now, the aspect where we find the cost of equity. Cost of equity, sometimes they may be given. So where cost of equity will be equal to T, or you can calculation where calculate the following. So we have here, these are formulas. So cost of equity is DO 1 plus G over PO plus G. So DO is equal to dividend paid. And then getting down to PO, stock price. G is a growth rate. Then what happens is we have also cost of equity. Cost of equity is equal to D1 over PO, then plus G. Excuse me, am I cruising too fast? Am I explaining too fast?
I think you're okay with me.
Okay, so what is happening is we are looking at how we are getting down to calculating the overall capitalization of the company. So I'm just giving a breakdown where these cost of prepared, so where they are coming, how you get this. So the examiner in the exam, they'll give you the information that will relate you to find the cost of equity. So what will matter when getting the cost of equity is the information given when you're calculating the cost of equity. The cost of debt, they provide already, because cost of debt is determined by the market interest rate. So they will give you already. So in case they haven't given you the cost of equity, you can use the information. If the information has to do with what is here, you use it. Or it has to do with this one, you use it. D1 is equal to expected dividend to be paid. Expected dividend to be paid. So dividend to be paid. Then G is a growth rate. G growth rate. Then P O is a stock price. So this is our stock price. So now we can also have using the CAPM, how we find the cost of equity. CAPM, I gave this one. Cost of equity is equal to risk-free plus beta, then return of the market minus the risk-free. So this one is the risk-free rate. And then this one is the beta. RM is the market return, so market return. So we have this one. Of course, the cost of preferred stock, number 3 now. So the cost of preferred stock.
Would you mind going back to the previous slide? So I missed out something.
Okay, no problem. So this other one. This is beta, then RM minus RF. This one is called market risk premium. Market risk premium. So this is just about what you need to know. In an exam, sometimes you may be lucky that these costs, the examiner will give you all the costs, so you just have to insert in the figures in the work equation. So yeah, okay, cost of preferred stock is equal to dividend on preferred stock then over net price of preferred stock. Net price of preferred stock. Then you multiply this one by 100%. So this is only how you get to the cost of preferred stock. So this is cost of preferred stock, dividend on preferred stock over the net price of the preferred stock. There is that breakdown, cost of preferred stock there. Of course, we get down to that one, the cost of equity and all that. So this is what the work will actually look at, the overall capitalization. So we can get down to the question from here. We can look at question 3. Okay, so the most important thing is for you to understand the catch, the concept. Now, I want me to explain where the weights come from. So this company, question 3, I'll explain where the weights come from. Where do the weights come from? Okay. So the weights come from the monetary value of the components in the capital structure. Okay. So we can get down to this so that we see what is going on here. All right. So we have this company, they issued how many shares? They issued the 320,000 shares of common stock. So this is the debenture, this is the debt from the capital structure. So they have a 6 million debt Then this is the preferred stock. Then this is the equity that this company has. So these are the three components. Are people with me?
Yes, I'm following.
So these are the components of the capital structure. So the capital of this Manix company, they have the debt of 6 billion, which is debenture and secured borrowing. So this is called unsecured borrowing. So there's no security. And then we can also look at the other aspect where we are getting to preferred stock. These are part-time owners. They are part-time, they buy small shares in the company. They are part-timers. Okay, they just be given a small dividend. Common stock, they form part of the. Of course, now we have gotten here, calculate the present weighted average cost of capital of this organization. They want us to find for them the weighted average cost of capital. So we'll answer this question bit by bit. So let me use this whiteboard to you explain this. We have what? The debentures. So debentures, how much? We have the debentures over, which is a debt here, which is giving us, according to what we have, is a 6 million. So we want to find, let us find the weights. We are going to find the weights here. So that one, we have the preferred stock. Preferred stock. Our preferred stock, we have the monetary value, which is a 2 million. Then we have common stock, which is equity. So common stock, we have under this one, the common stock, we had 8 million. So meaning that the total here, we need to actually find the total. The total is 16 million. So from this 16 million, we can find the weights. So the first weight will be 6 million. Okay, so 6 million divided by 16, which is giving us the 0. What? So it's this percentage of the total. So this one is giving us what? The 0.375. I'm sure. So for debt, we are simply saying for debt is actually equal to 6 million. Then you're dividing by what? 16 million to find the weights. So which is giving us a 0.375. So we are getting the weight of debt. So the weight of preferred stock will be 2 million. So it is 0.12 what? 0.125. Then the other one will be 0.5. Which is giving us the 1.00, the total weight. Are people with me so far?
Yes.
So this is how you're getting the weights. Please, the weights, they come from the monetary value of components in the capital structure. So weights come from, come from monetary values of components in the capital structure. All right, so this is just the major catch of what you need to know about the work. So meaning these weights, we have them, the 0.375, the 0.125, the 0.50. Then getting down to the other thing from this one, they have given us, so we need to know what they have given us. So they have given us what? The tax rate is 40%. Our tax is 40% from that question. Take note. Then the return on equity, required return on equity is 17. So here we are lucky. Cost of equity was given 17%. No need for us to go an extra mile. All right. And then the Manix debt is trading at 13%. Cost of debt is 13%. Okay, so the debt here is at 13%. The cost of preferred stock is at 12%. Cost of preferred stock is at 12%. So meaning everything else has been given. So we need to substitute and get the values. So getting down to the work. So our work is actually going to be equal to weight of equity, cost of equity, plus weight of debt multiplied by cost of debt, 1 minus tax, then plus weight of preferred stock multiplied by cost of preferred stock. So the most important thing is just to understand the catch. So our work is actually going to be the weight of equity is 0.5 from the capital structure. The cost of equity is 0.17 that has been given. Then plus the weight of debt, debentures 0.375, 0.375 multiplied by cost of debt. All right, this cost of debt is 0.13. Then 1 minus the taxation is 0.4. So from here, we can say plus the weight of preferred stock is 0.125. Then multiplied by the cost of preferred stock is 0.12. So just sorting out this, we are finding the overall capitalization of the company will actually be, so we'll get to 0.5 by 0.17, then plus the 0.375 by 0.13 by 0.6 as we subtract, and plus as we multiply 0.125 by 0.12. It's giving us the 0.12925, or we are simply saying 12.925%. All right. I'm sure you have gotten something so far. Is it clear so far?
Yes.
Okay, so we can end the class for now. I think this video Mr. Njobu will be able to share with you. We'll be building up what is remaining for these topics. We'll get deeper in terms of these topics as we progress, as we proceed. Unless there are any questions, but we can end the class for now. I'm sure this video will be shared with you.
So when is the next class so that we prepare in advance?
Okay, so the next class, just let Mr. Njovu know about it. I think he get in touch with Mr. Collins. He will update you on when the next class will be.
All right, noted.
Okay, thanks very much.